Hello, hello, hello. Welcome back to the podcast. Thank you very much for being here. I appreciate it. You guys, I just got back from a week with colleagues. And let me tell you, it was amazing. I got to go to Indianapolis. Most of my insurance, I write with One America. And I got to spend a week at the home office. They do this symposium thing and they bring in all these awesome speakers and we get to learn all about insurance. And so for some of you, that might sound kind of boring. For me, that's exciting. So I was there all last week from this recording. I was there all last week and we learned a lot. So I'm back. And I'm tired. It takes a lot out of me when I travel and do stuff like that because I'm up. I mean, like 10 o'clock, but 10 o'clock there is 11 o'clock our time. And I'm tired. And I end up talking all day and it's so fun to hang out with people. But it's exhausting. So I'm here. If I look tired, it's because I'm tired. And I feel like I look tired. All right. Today we are going to talk about loans. This is truly one of the most confusing topics when we talk about infinite banking. And it is because life insurance companies are not banks. I have said that before. I will say it over and over and over and over and over. Life insurance companies are not banks. We have turned them into banks. We cannot expect them to act like a bank. They are a life insurance company. Their number one objective is to make sure that they have the money to pay the claim. They want to make sure that they have a good product to sell you. They want to make sure that they are managing their portfolio so that when that claim comes, they have the money to pay it. We make them banking. They do not provide you amortization schedules. They do not tell you when loans have to be paid back. They do not ask what you are taking the loan for. Those are all benefits. But that then means that you have to be an honest banker. And Nelson talks about that in his book. I talk about that in my book. You need to be an honest banker. You should be doing amortization schedules. You might have to do a little more work on figuring out how this loan thing works. And here's what I'm going to talk about. I had somebody ask me that I have this new client that I'm working with, and he's really, really trying to get a hold of what is happening in this policy. And so he is asking a ton of questions, which I absolutely love, because if you're asking questions, that means that you want to learn it. You're not just trusting me to tell you what to do. So his question is, and confusion came around when I told him, if the insurance company charges you 4% to borrow money, that 4% is not going back into cash value. And he then was confused because he has listened to Nelson's book 3 times, listened to my book twice. And he said, but in Nelson's book, it sounds like it's going back into cash value. It sounds like it, but that is not what Nelson is saying. You pay if the insurance company is going to charge you 4%, 5%, whatever the heck it is. For this illustration purposes, we're going to talk about 4%. If the insurance company is going to charge you 4%, that 4% interest goes to the insurance company. Okay? Nelson and I both talk about being honest bankers. If you are going to pay 6, 7, 8% to a bank, to a credit card company, pay that back to yourself. Meaning, if the insurance company charges you 4%, and you decide you're going to pay yourself back 8%, 4 of that is going to go to the insurance company. The other 4 of that goes to you. Now, here's where it gets confusing. We can only put so much money into a policy before it becomes a modified endowment contract. So let's say, for example, we have a $10,000 premium. We've paid our $10,000, but we're going to pay our loan back in 1 year, and we're going to add an extra 4% on. Let's say that 4% is $1,000. Guess what? That $1,000 cannot go into the policy because it would mech the policy. There are rules and guidelines of how we can fill this policy. So we cannot just randomly throw extra money in. Even though in our head it was a loan repayment, okay? If we borrowed $100,000 and we're going to pay back $100,000, that's it. That's all we can pay back is $100,000 plus the 4% interest. That's it. We can't pay back $100,000 plus 4% extra because the extra does not go in as a loan repayment. The insurance company does not say, oh, yes, I understand that you want to pay me 8%. No, they don't do that because that's not how it works. They have guidelines to follow. So the extra 4% in Nelson's illustrations in the book would go in as extra premium, not loan repayment. If you borrow 100, you could only put 100 back. If you want to put the extra 1,000 back, if you want to put the extra 1,000 in as a loan repayment, technically to the insurance company, it would be a premium payment to paid up additions. But you've already filled your policy up. So now we don't have room for it. So what do we do with it? Well, we might have to put it in a savings account. If it's going to be a constant thing, maybe we want to start another policy with it. These are super confusing to so many people. And at some point, I may have to actually illustrate this with like money and jars or whatever. But we cannot, if you set your premium, whatever your max premium is every year, that's all you can put in because of the modified endowment contract. Well, but Nelson makes it look like. Well, no, Nelson doesn't make it look like anything. Nelson is trying to illustrate what is happening in the policy. If you were to pay more above and beyond what the insurance company is charging you, what would you have? Right? He's showing you that if we have this forced savings, what that looks like. It is illustration purposes. It's to make you think. Now, this same person asked me, well, Mary Jo, I have money that I can borrow that's invested in the market. What would be the difference if I did that? Well, the difference would be that you don't own the company that gets the interest. So in Nelson's book, he talks about the CD sister versus the IBC sister. One has a CD that she uses as collateral to a bank loan. The other one uses her life insurance policy. A lot of people miss this piece of Nelson's book because, he just talked in stories, and that's hard for some people to understand. So what he was saying is if you go to the bank and get a CD, and then, or you go to the bank, you put money into a CD, then you march your butt over to the loan officer's office and you say, hey, I want to borrow money from the bank, but I want to leave my CD there as collateral. The bank will say, oh, we're going to give you a little bit better interest rate. Side note here, I just had a banker tell me to do this a month ago. With interest rates rising, they're now telling me to use a strategy that was used from 1980. Pretty crazy. Anywho, so in that scenario, if I have a CD and then I go to the bank to borrow money, I'm essentially doing the exact same thing as the infinite banking concept. The only difference is when I pay the bank the money, who makes the profit? The bank. When I borrow money from the life insurance company, who makes the profit? I do. I make some of that money back in the form of a dividend, right? Because I own part of that company. The dividends are huge. If my company is lending money and making a profit off of other things, and less people are dying, and I get that back, some of that back, not all of that. That is another misunderstanding. People think, oh, you get all your money back. No, you don't get all your 4% back. If you pay 4%, you do not get 4% back. It just does not work that way. The company makes a profit minus expenses, hence dividend, net dividend. Okay. It's a formula. So if I can own part of the company, why wouldn't I do business with my company? Remember when Nelson talked about doing business with your grocery store? Why would you go to a different grocery store? So let's just pretend that you own the grocery store. And now you go to Walmart to buy your groceries because it's cheaper than your grocery store. Would you do that? No. Then why would you do that? Go to the bank to borrow money. Now, sometimes we try to make that make sense, right? If I can go to the bank and get a 2% loan, why wouldn't I do that over going to the life insurance policy and taking a 4% loan? Nelson would say you go to the life insurance policy. Interest rates don't matter. Depends what you have going on in life. But if we want to beat inflation, which is what everybody's talking about, does the life insurance policy beat inflation? This is not an inflation hedge. Sorry to say, not an inflation hedge. However, Nelson said, if we go to the bank to borrow money, we are part of the problem. Why? Because the bank turns money and creates more money, and the feds will just create inflation. It is a cycle. So we need to break the cycle. We need to stop going to the bank. I no longer have bank loans. Well, I have one. Okay, sorry. I have one on our land. That's it. Otherwise, nothing else. Everything else I have paid for through my policy. Interest rate doesn't matter to me at this point. It is the hassle of it all. But I then have to control that loan, and I have to be the banker, and I have to understand how that loan rate works. So this is truly super confusing when you start reading books and talking to people about infinite banking. Well, is it going back in? My interest is going back into the policy and it's accumulating more money. No, it's not. The interest is going to the insurance company. Some of that comes back to you as a dividend. Anything extra can go into the policy if there is room. Otherwise, it's going to mech the policy, and then we have to start new policies. Why did Nelson have 49 policies? Because he always paid himself more interest, and then the extra interest went to start more policies. So there's a lot to this. It's not as easy as saying, oh, you know what? I'm just going to go buy a life insurance policy and I get the whole concept. I wish it were that easy, but it's not that easy. Having somebody understand and be able to answer these questions for you is super important. The gentleman that I am working with right now has a lot of questions every single time. In fact, we joked when we got off our meeting yesterday. I said, okay, I'll be looking for an email with more questions tomorrow, because that's typically what happens is he has more questions. That's why I'm here. That's why I'm the teacher, is so that I can answer those questions. I didn't have to look back into Nelson's book because I've read the book many, many, many times. I know what Nelson is doing. I've studied the concepts. When he asked those questions, I knew exactly where he was going with those questions because everybody else has had those questions along the way. So if you decide that you're going to work with somebody that's not an infinite banking practitioner, that doesn't understand what Nelson was trying to teach, then how are you going to get those questions answered? You're going to know a little bit about infinite banking because maybe you've read my book, maybe you've got a policy, but understanding the full concept of it is going to be very, very hard. So you're going to want to make sure that you are working with an agent that knows and understands what Nelson is teaching. Okay, I hope that I was able to kind of clear that up. I still feel like in my head, it's as clear as mud. So I'm going to have to figure out how to illustrate this. And most of you are listening to the podcast, which it is very hard to illustrate it as you're listening. It's much easier to see it. So I'll work on that. I'll figure it out. All right. Let me know, you guys, if you have comments, questions. Let me know if for whatever reason you might have a topic that you want covered. I am happy to have suggestions because, I'm kind of running out of things to say. And I'm just going to start repeating myself, which maybe is not a bad thing. But if I don't have to, I don't want to. And sometimes there's things so basic that I think are basic because I talk about them every day, all day. And I forget that you guys don't know those. So if you have some very basic questions, if you have any questions at all, they're not bad questions. Shoot them over. Happy to answer them. Okay. Mary Jo at withoutthebank.com. Go to farmingwithoutthebank.com, grab your book. Grab Nelson's book. They are a bundle price. Get them both. You are going to want them both. Let me tell you, people will say, well, Mary Jo, I haven't read a book, or I've never read a book cover to cover, but I did yours. Yes. And then that actually leads to more reading and more reading and more research and so on and so forth. And so it opens up the big bad world. So get both of them right away. Why not? It'll be cheaper for you. Be on the lookout. If you are in the Cody, Wyoming area, I am going to be in Cody. So be on the lookout for tickets because you can go to farmingwithoutthebank.com/events and you will be able to get your ticket for Cody there. It's a $25 ticket. It is not expensive. I just want to be able to cover a rental of a room. That is it. So please make sure that you get your tickets. We will be there September 14th and it will be an evening presentation. I'm just not sure where we are having it yet because we are still looking for a location. So make sure if you want to you want to see me live and you are around the Cody area that you get your ticket. All right, guys, thanks. And you have a fantastic rest of your day.